This video is based on monetary policy via the transmission mechanism in terms of using the central bank policy rate to tackle inflation. So this particular video is specifically looking at the exchange rate. So how the central bank policy rate can influence the exchange rate, which then again, as I mentioned before, helps to tackle the inflation rate. So let's imagine in this hypothetical situation, the inflation rate is above target. So that target is 2%. And if it's above that 2%, then maybe the central bank might have to intervene. And the Monetary Policy Committee might decide to increase the central bank policy rate. So now what we need to consider is, okay, if they increase the policy rate, the base rate of interest, then how is that going to have an impact on exchange rates, and why would that tackle inflation? And to consider that, we have to look at the Forex market. Now, the Forex market is simply where currencies trade. So this market determines foreign exchange rates for every currency. So it includes all aspects of buying, selling and exchanging currencies. So if we've got a scenario, and let's look at the Bank of England as the central bank for the UK. Now, they've had interest rates pretty low for some time, but let's imagine that maybe in the next year we start to see inflation continue to rise, so therefore the interest rate starts to rise as well. And maybe in, I don't know, a 12-month period, perhaps they increase it by 3 percentage points. So let's say a hypothetical situation, it goes up to 3.1%. Now, again, you might think, well, how does that relate to the exchange rate? Well, we have to consider the interest rate and the base rate of interest in other countries. So let's have a look at the Eurozone. The Eurozone is 0%. Now, with regards to 0%, they might, because they're already lower and maybe the Bank of England have acted quicker than the Eurozone, maybe the Eurozone are also experiencing inflation and they are just about to, but at this moment in time, the UK has acted faster and their interest rate is higher. And what we have to consider is the viewpoint and the mindset of European firms looking for the best return on their money. If we've got, for example, a business or a company located in France or Germany who've got millions and millions of euros in their bank and they're looking for the best return whilst it's there, not being spent, not being reinvested, again, they might not just stick to the Eurozone financial institutes, but they might look elsewhere and they might look abroad. And they might look at the UK and think, actually, for this time being, maybe, based on the current exchange rate, but maybe we could actually store it in UK banks. Now, if they're going to store it in UK banks, they cannot store euros. So what they have to do is they have to go to the Forex market and they have to supply their euros. So it'll go from S1 to S2 and they're supplying their euros to the Forex market. The reason why they're supplying their euro is because they're demanding the pound. Now, via supplying their euros to demand the pound, what that will do is it'll depreciate the euro and it'll appreciate the pound. And in doing so, it'll have an impact on the exchange rate. So, what this is called, this is known as hot money. So hot money flows refer to capital flows moving to countries with higher interest rates and or expected changes in exchange rates. So let's imagine this French firm, geographically close to the UK. They're looking at a quick return on some of their euros. They're searching for hot money. They decide to convert into, obviously, pounds to then store it in UK banks. And by doing so, and again, this is not just one individual firm. These are firms across the whole of the Eurozone. In doing so, they appreciate the pound. Now, by appreciating the pound, we can use this acronym called SPICED. Now, what SPICED stands for is strong pound, imports cheaper, exports dearer. So what I mean by that is more expensive. And when we start to use this acronym, we can start to break down how the exchange rate can actually have an impact and how it can start to tackle inflation. Because if imports are cheaper and exports are dearer, and we refer to the circular flow of income, what we'll see is imports becoming more attractive and therefore withdrawals and leakages from national income will start to rise. But exports become less competitive and less attractive because they're more expensive. So foreign firms may choose not to buy from the UK and therefore injections will fall. And in doing so, what we'll find is net exports will fall and therefore so will aggregate demand. And we'll start to see an AD shift if everything else is the same, AD1 shifts to AD2, and we start to see that price level fall from P1 to P2. Now, when I say the price level to fall, I'm not necessarily suggesting an Armageddon statement such as deflation, because you have to remember the whole reason for this contraction in monetary policy was because it was above target. So the chances of it being above target to, for example, deflation is unrealistic. But what we could say is disinflation. Now, so what we've got here, if we look at the whole transmission mechanism, we've got the central bank policy rate, which they increased the base rate of interest. In doing so, it causes foreign firms searching for hot money to convert their currency into pounds. By demanding the pound, it'll appreciate the pound, which will mean that import prices become cheaper. So that will also mean that if you're looking at cost of production for UK firms, that will probably fall as well, because maybe a lot of their commodities and a lot of their inputs are also bought from abroad. But it'll also mean that net exports fall and it'll reduce AD. And in doing so, it'll help to tackle that inflation that target and bring it back to that 2% target that they're hoping to achieve. Now, if we're looking at realistic examples or real life examples, in 2016, Argentina, when trying to tackle their inflation rate, they increased their interest rate to 38%, which is obviously incredibly high, especially if we compare it to the likes of the UK and the Eurozone. And in doing so, that caused a surge of hot money inflows, strengthening the peso.